Hello, I'm Jeff Selke. Welcome to our economic and market update, third quarter of 2019. It is October of 2019 that we are recording this update on the stock market and the economy. This is something we do for our clients every 6 months. And if you're seeing this and you're not a client, this is just a little bit of information about me. My name is Jeff Selke. I am the founder and president of Selke Financial Group. I've been helping people with retirement and wealth management strategies since 1998. I'm the author of 2 books, Making Your Dream Retirement a Reality and Retire Today. I'm ranked in the top 1% nationwide of all financial advisors. I'm a chartered financial consultant. That's a designation that requires 9 college-level courses and passing a test on every one, from estate planning, tax planning, investment management, financial planning, and other subjects. I'm a regular guest on TV shows on CBS and other television stations. I have my own radio show that I've been doing for now for 8 years, and that's on Saturdays on KNRS and KSL, and at various times. I am an investment advisor representative, a fiduciary, and today I'm going to update you on the stock market and the economy and what's going on and what you need to be aware of. Today we're going to cover a review of 2019, what's happened so far, what we're seeing right now in the current state of the economy and the stock market, and where we go from here. So let's get started. Hot topics as of now. China. China's in the news every day. The president might tweet something. China might say something. So every day we're hearing something about China. And it does move the market up or down, depending on if it's good. There has been a soft trade war between the United States and maybe a trade disagreement between China and the United States, and that has caused volatility in the stock market and concern, and rightfully so. If both China and the United States add tariffs onto each other's goods, that hurts the economy because it causes us as consumers to have to pay more. So it is a very legitimate concern about what's going on, and something that's going to remain in the news for a while. Exports from China and to the United States have gone down recently, as we can see in this chart, and that is something we're watching very closely. There is hope that an agreement could be on the horizon. At the same time, this has been going on for now over years, and the fact that we don't have an agreement is not a great sign, and it's causing some pessimism. So that's something we've got to watch carefully, is what happens between the United States and China. Do we get an agreement? Is it a fair agreement and a good agreement for the United States and for our economy? Election. As of this time, looks like the markets, which is really Vegas, the odds makers, are betting that Trump is going to win re-election in 2020. But the election of 2020 is also creating uncertainty. And there will be uncertainty until the election is over, because we just don't know who's going to be president and what their philosophy and strategy is going to be going forward as far as tax policy, financial policy, and many other things, regulations. Impeachment is another thing that's in the news, of course, right now. The Democrats in the House of Representatives are pursuing impeachment proceedings, or at least looking at it, against President Trump. And there's some uncertainty as to what does that mean for the stock market and the economy. What's interesting, if we look at the last 2 impeachments that have happened, Nixon, who really resigned before he was impeached, and President Clinton, who was impeached by the House of Representatives, what happened to the stock market after that period of time? And as we can see, the blue on the chart represents the time after President Nixon resigned, was going to be impeached. And we can see that a year after that period, the markets were down 33%. So whether it was specifically that uncertainty that came from his resignation, the market was down quite a bit. Now, if we look at the orange bar charts, that is what the stock market did, the S&P 500, the US stock market did after President Clinton was impeached in 1998. And we can see that the stock market was up very handsomely. 6 months later, the market was up 41%, a year later up 39%. So the stock market has had different reactions, different time periods, different economies, But basically what this tells us is we don't know what impeachment is going to mean for the stock market. It could be a positive thing for the stock market, or it could be a very negative thing, and the stock market could go down. So it is something you've got to watch very closely. The stock market, the economy, I'd say in general, the feeling, the sentiment of many people out there and the media is, our opinion is that it feels worse than it really is. This chart is showing the S&P 500, the stock market is the red line, and you can see how it steadily has gone up since the crash of 2008. So this is just the last 10 years, really. And the blue chart represents bullish sentiment, meaning do investors feel positive about investing in the stock market? And you can see that we're at near lows in sentiment. That means investors in general are pessimistic and fearful about the future of the stock market right now. That could be a combination of China, impeachment, political unrest, many other things. The fact that the stock market is so high, I mean, there's lots of reasons for that, but that's really interesting that the stock market is at or near all-time highs, and yet investors are pessimistic at this time. Investors are also nervous, and we see that in this chart that shows the percent of consumers that expect the stock market to fall, and it's up to about 60%. So 60%, more than half of investors expect the stock market to decline. And again, that's a very interesting sentiment considering the stock market is at or near all-time highs at this time. Investors, again, are not bullish. Money is being pulled out of equity mutual funds. So in 401ks, IRAs, mutual fund investments, money is leaving those funds. Now, where it's going, some of it's going to bonds, some of it's going to ETFs, some of it's going to individual stocks, but a lot of it is leaving the stock market and going to cash or bonds. And so that's a really interesting dynamic that's happening right now as some investors are pessimistic on the future of the stock market. And so that pessimism is something that we do have to watch constantly because you just don't know how that's going to affect the actual market. Couple things. Many people are asking me, well, Jeff, they call my radio show and they say, but the market has gone up a lot. It's up too high. We're at all-time highs. It can't go any higher. From 1950 to 2017, the S&P 500 spent roughly 32%, about a third of its life, within 5% of the all-time high. So what that's saying is the stock market, a third of the time, is right at or close to an all-time high. So it's very normal for it to spend a lot of time there. This is another interesting statistic. 82% of the time when the S&P 500 makes a new all-time high, the market is even higher 6 months later. So when we're thinking, oh, we can't go any higher, we've reached all-time highs, it's got to come down from here, most of the time, 80% of the time, the market's actually up even higher 6 months later. And this shows the average returns of the stock market after reaching an all-time high. And you can see on average, the market is 14% higher a year later after reaching an all-time high. 5 years later, on average, it's up 9.9% higher. So what this tells us is that momentum matters. And if there is strength and momentum and the stock market's going higher, there's a good chance that it continues higher for some time. That's a very positive thing for the stock market. Okay, let's talk about fundamentals. This is a chart of the stock market over the last 20 years. The gray line represents the S&P 500, the U.S. stock market. The purple represents international stock markets, which is really the MSCI, that's Europe and Asia index. And you can see that the U.S. stock market has gone up considerably, over 300% since the crash of 2008, whereas international markets are only up about 107%. So there is a real dichotomy there in returns. That's something we're watching very closely. Europe and Asia just are not doing well right now. Europe is borderline in recession. We see negative interest rates in Germany and in Japan, and so it's something we're watching very closely to see if there's a turnaround. And because international stocks are cheap compared to the United States, is this a good time to invest in them? So that's something we're watching very constantly. But at the same time, again, those economies are not doing well right now. So proceed with caution. Earnings growth is normal. It's slowing. It's slower than it was in 2018, but it's still growing. And what that means, earnings growth just means revenues, money. How much money are the big corporations in the United States making? And what this chart shows us is that earnings have been growing for the past decade, and they continue to grow today. So even though earnings are slowing down, they're not growing as quickly as they did last year, they are still growing. And that's something we're watching. And as long as earnings are growing, companies are profitable, the stock market tends to go up. In fact, this chart shows that, that earnings really drive stock prices. If you look at the blue line represents the S&P 500 earnings or revenue, so how much money are they making? And the yellow line represents the stock market as we know it, the price of the stock market. And you can see that the two lines nearly mimic each other. And so this is really what drives the stock market long term. Short term, of course, politics, war, threats, trade wars, all those kind of things, yes, they do cause problems for the stock market in the short term, but in the long term, the stock market is really moved by growth in earnings. So if companies are profitable, they're making more money, then the stock market should tend to go up. And right now, companies are very profitable. This is interesting. Since February of 2018, the stock market is actually only up about 4%. So it has not been a great year and a half time period for the stock market. It's been a great stock market since January 1st of 2019. Earnings of those companies are 49% higher than they were in February of 2018. So think about that. Earnings are up almost 50%, and yet stock prices are only up 4% since February of 2018. That means that the stock market is cheaper than it was a year and a half ago from a price standpoint. How expensive are stocks? How cheap are stocks? Basically what this chart is telling us is that stocks are fairly valued. That line right in the middle, a dotted line that says the 25-year average, that's talking about the PE ratio or price to earnings ratio. It's basically, are these companies cheap, are they expensive, are they fairly priced? And where we're at right now, it says we're fairly priced. The stock market is not cheap by any means, but it is also not highly overvalued like it was back in 2000 before the dot-com bubble burst. So that's a good thing. That means there's still potentially room to run for the stock market. The labor market is in great condition. Unemployment's low. That dark line at the top, that is unemployment. We can see it's down to about 3.5%. That's amazing. That's a 50-year low in unemployment, and that is a wonderful thing. And so if people are employed, if people have jobs and they're spending money, then the economy will continue to grow and the stock market should continue to go up. And right now, unemployment is so low and people have jobs, they're spending money, and that is what is driving the United States economy. That's what's driving the economy here, is the fact that people are spending money. This is the longest economic expansion or bull market we've had ever. And that's a great thing that it's the longest one. But again, many people are worried because, hey, times have been good for 10 years. Aren't we overdue for a correction or for a recession? And the quick answer to that is yes, we are overdue from a historical standpoint. But the economy is still growing, unemployment's still low, companies are still profitable, so there's a reason that the economy is still growing and not going into recession. And we see that continuing at least for the foreseeable future. And by that I mean 6 months to a year. Anything could change this. Political, the election of 2020 could change things depending on what happens. If trade war with China gets worse, that could change things. If a war breaks out, that could change things. So there are a lot of situations that could happen in the world that could change what's happening right now and cause us to go into recession. But as of right now, the economy still looks strong and looks like it's going to grow for the next year or two. Interest rates are low. That's a great thing for the economy. It's not good if you're a saver. If you're a good saver, and you probably are, and you've got money in the bank or in bonds or CDs at the bank or anything like that, you're not getting any interest for that, or you're getting very low interest on your savings. It's a terrible thing for savers, but low interest rates are a great thing for borrowers. So for a lot of the big companies that need to borrow money to grow, that's a great thing. They can borrow for really cheap right now, reinvest that money, and grow their profits even more. So low interest rates are a good thing for the economy. Bottom line, here as the fourth quarter of 2019, as we enter that. What do we see as the tailwinds and headwinds? What's going on? What are the pros and cons? So tailwinds, what's pushing us? What's good? Again, a quick summary: the strong labor market, wages are increasing, average U.S. earnings growth and net margins. Again, companies are making more money. Manufacturing service sectors are at non-recession levels. Just means they're not showing a recession, signs of a recession right now, although they are slowing, so it's something we're watching. Corporate balance sheets are very strong, meaning companies, the big companies, have a lot of cash, a lot of money. Valuations are back to 2014 levels for the stock market, and that just means, again, the stock market is fairly valued and could be a good place to invest. Household balance sheets are solid. Debt levels are low for households, even though our national debt is way too high. GDP, that's gross domestic product, the growth of the economy, is still at about 2%. That's outstanding. So if we can keep growing at 2%, if we can raise that to 3%, then the economy can continue to grow and the stock market can continue to rise. So what are the headwinds? What are the things that could derail the economy, stop the growth in the economy and the stock market, and cause maybe a large downturn in the stock market and your retirement accounts? Trade tensions and tariffs, as we discussed. How much worse is it going to get? Again, if we go into a full-blown trade war with China, that's bad for both economies and probably puts us into a recession. Weaker global economies, especially in China. China's economy is not doing well, so they really need this agreement to help their economy. The trade dispute is not helping China. Slower earnings growth rate in 2019, so we're expecting earnings to slow down, the growth, but still to grow. Poor investor sentiment, again, that's something that can weigh on the market, because if too many people are pessimistic and pulling their money out of the stock market, it could cause a downturn just because people are fearful and pulling their money out. Oil prices have fallen. That's both good and bad for the consumer. That's good. That means we're paying less at the pump. So that's a great thing for us. But oil prices being down can be a sign of future recession, or can cause problems, because those big oil and gas companies are now making less money. Maybe they hire less people or they lay off people because they're not able to do as much drilling. So there are some headwinds, some issues that we have going forward. What's our playbook? What do things look like for us here at Segelke Financial Group as a fiduciary firm managing wealth? The markets will most likely have more volatility ahead. We do believe this volatility is going to continue. You're going to see big ups and big downs. Investors are not prepared for a full-blown trade war or a socialist president. Either one of those things could hurt the stock market and the economy. Very little of the money you need to live on over the next 5 to 7 years should be in the stock market. And this is always the rule. This isn't something new. That doesn't mean if you're 5 years away from retirement, or if you're in retirement, you shouldn't have any money in the stock market. It's just saying that money that you're going to need to use in the next 5 years probably should not be in the stock market. So you should have some safer investments, whether that's cash, bonds, annuities, fixed annuities, something that can protect your wealth and make sure you don't lose big when the market does take a downturn, so that you can leave your stock portfolio alone and let it grow back. If earnings estimates are correct for 2018, the S&P 500 valuations are right at the long-term average. So again, that's a good thing. Emerging markets are very cheap compared to the United States. Emerging markets are the smaller international countries. So they have a lot of room for growth. At the same time, they are very risky right now. So tread with caution. U.S. small and mid-cap stocks are cheap compared to large stocks, so they have more growth opportunities. So that's something we're looking at for our clients, is adding maybe a little bit more small cap exposure, because there's more growth there, and as long as the economy stays good, you have the chance to make greater profits. We think there'll be one more rate cut by the Federal Reserve, and then they'll probably halt unless a recession comes around. Then of course they'll lower rates more. If the economy continues to improve, stock market continues higher, they'll probably look at raising rates again, maybe next year or the year after. If you're going to own bonds, we always recommend owning individual bonds rather than bond funds. Now that's not possible in all circumstances, because in order to own individual bonds, you've got to have a decent amount, and I say $250,000 really of investable money to have a good diversified individual bond portfolio. But if possible, owning individual bonds is the way to go versus bond funds. And that's it. That's our economic update for the third and going into the fourth quarter of 2019. We hope you've enjoyed this. Hope this has been educational and given you an update on the economy. Again, we here at Segelke Financial Group, Fiduciary Wealth Management firm, feel very comfortable with the stock market right now. We think there's room for growth and that we can reach all-time highs again on the stock market, and it can continue higher. At the same time, we are watching it very closely and looking for signs that could cause a downturn in the stock market. If you're going to invest in the stock market, you've got to have a strategy to protect yourself on the downside. Otherwise, you're taking the risk of losing 30, 40, 50% or worse. And so that's something we do for our clients. Our motto is protect and grow our clients' wealth. So we want to protect and grow your wealth. In fact, our website is protectandgrowwealth.com. Feel free to visit it if you'd like more information or if you'd like to ask us any questions. Happy to answer those. Our phone number and email is there below. And our mission is to empower and enable our clients to achieve financial independence and a work optional lifestyle through our proprietary time-tested process. That's really what we're doing here, is trying to bring peace of mind and financial stability to people's lives. Hope you've enjoyed this. Have a great rest of your day, and wish you all the best. Take care.